afternoon. Please take your seats. We'll get started. Alumni, friends, students, staff, and faculty, welcome to the 19th Annual W.C. Lacy Distinguished Lecture, and welcome home to the University of Arizona. Before I get completely started, I want to tell you we have great students, and I fear that you might think they're rude, but about half of them have a chemistry exam starting at 5 p.m. So if you see a mass exodus at 4:50, that's where they're headed. I'm Cray Luxbacher, the Gregory H. and Lisa S. Boyce Leadership Chair of Mining and Geological Engineering, and it really is a pleasure to have you all here today. I'd like to first acknowledge our own Denise Sandoval, who is responsible for putting today together, and she really did an outstanding job. Before I give you a little background on our lecture and introduce our distinguished guest, I would like to share with you our university land acknowledgement. We respectfully acknowledge the University of Arizona is on the land and territories of indigenous peoples. Today, Arizona is home to 22 federally recognized tribes, with Tucson being home to the O'odham and the Yaqui. Committed to diversity and inclusion, the university strives to build sustainable relationships with sovereign Native nations and indigenous communities through education offerings, partnerships, and community service. This lecture was generously endowed by Tom and Peggy O'Neill, who are with us today, in memory of Willard C. Lacy, who was known as Bill. Bill was pursuing a PhD at Harvard when his education was interrupted by World War II. He took a job with Titanium Alloy Manufacturing Company as part of the nation's strategic materials supply effort. As you know, critical minerals are nothing new. When this program was completed, he served in the U.S. Navy. After the war, Bill completed his PhD and began a career with Cerro de Pasco Copper Company in Peru, where he rose to chief geologist in 1953. In 1955, he returned to the U.S. and was ultimately asked to establish and head a combined department of mining and geological engineering. He defined requirements for both undergraduate programs, had them accredited, and then established MS and PhD programs in both disciplines. Students characterized his teaching as challenging them with unsolvable problems, while at the same time providing a framework for analysis, always with a view of the big picture. Today, our department stands on his legacy, and we are pleased to carry on his philosophy by hosting this lecture series to deliver a big picture perspective. We are fortunate to have his son, John Lacy, Director of Global Mining Law Center and Professor of Practice here at the U of A, and his wife, Terry, with us tonight. Now, it is my honor to introduce our speaker, Tim Snider. Tim has worked in the copper industry for 54 years, and he is currently chairman and co-founder of Cupric Canyon Capital, a private equity company formed in 2010 in conjunction with London-based Global Natural Resources Investments. The company's purpose is to identify, acquire, and develop mineral assets worldwide. Tim started his career as an underground mine laborer and ultimately rose to president and chief operating officer of Phelps Dodge in 2003. At the time, it was among the largest publicly held copper producers in the world. During his time there, he introduced and advanced hydrometallurgical processing and developed Candelaria in Chile, Safford in Arizona, and Tiki Fungurumi in the DRC. He currently serves as Director of Tech Resources in Vancouver and has served on nonprofit boards, including our own Institute for Mineral Resources as the founding chairman. Tim is a native of Arizona. He completed the Advanced Management program at the University of Pennsylvania's Wharton Business School. He earned his BS in Chemistry and Geology from Northern Arizona University in 1979, but this is important, he attended the U of A in 1969. We're proud to call him an engineering alumnus. His wife, Rhonda, joins him this afternoon. Welcome, Tim.
Well, thanks, Craig. That was a very generous introduction. And first of all, I'm pleased to be here. And I've spent the day, you know, when you get designated this lecture, they have you come to the engineer's breakfast and then keep you well-fed and busy all day long. And so, you know, I was able to meet with faculty and students over lunch and subsequently, and you know, every time I do stuff like that, it raises my spirits. You know, what I see is a generation of students that are going to be well prepared for this industry, and the industry is going to need it. You know, you know, the problem that we have in this industry is that we have a looming demand for all sorts of metals and mined products, but not nearly enough people studying to enter the profession. And I'm very, very pleased with what the U of A is doing in that regard, and other institutions around the country. But you know, I think we all need to work together to try to advance that and increase the number of people that would be interested in such an endeavor. So anyway, thanks for inviting me here. I'm going to talk today about what I call the evolution of a copper mine. And but before I do that, I want to talk a little bit about safety. You know, this is a slide that is you can go look at the same slide on the ICMM website, and that's the International Conference of Mining and Metals. And it's an organization that's put together by a lot of the major mining companies around the world. Freeport is a key part of that. And you know, what they do is they're the face of the industry on a variety of things having to do with sustainability and safety and security and a whole variety of things. And what they do is they bring the industry to consensus on certain things like tailings design criteria, for example, plus a bunch of other stuff. And I would encourage you to go on their website and see what they do. It's a great organization. But anyway, what this shows is the safety record of all the mining operations of those member companies, which is worldwide. And again, most of the major mining companies are members. And you know, so if you look at this, the total recordable injury rate as measured per injuries per 1 million work hours over the last 12 years has been cut in half. It's gone from 5 down to about 2.5 last year. I think was the last year on this. And you know, just to put that in perspective, 1 million work hours, if you are an employee and you work 2,000 hours a year, you'd have to work 500 years to reach 1 million work hours. And so at a rate of 2.5 injuries per million work hours, that means that you might have an injury once every 200 years. Now that's the average. Obviously, there's some professions, some workers that have a much higher exposure than others, but the point of that is that if you look at mining from the outside, you would think that must be a very dangerous occupation. It must be really dangerous. The fact is, the industry works to make it one of the safest industries. And the way they do that is they work throughout the industry. They work on safety continuously, incorporated into everything that they do. So safety isn't separate. It's incorporated in every job, and they drive that. And so students that are entering the industry can rest assured, and you need to make sure this continues when you join the industry, is that safety is taken very seriously and is embedded. And so it's your job when you take over is to keep it that way and drive this number down to 0. So I think it's something for the industry to be proud of, and you need to know that you are joining an industry that takes it very seriously. So I do want to talk some about the Cupric Canyon Capital, how we came to be, and how investors might look at the business, and investors might make decisions based on what they see. But at the end of the day, what we did is we formed in 2010. We We sought out opportunities worldwide. We saw one in Botswana that we liked, and we got our partner investors to make the investments necessary to bring it all the way to production. And I'll talk a little bit more about that in a few minutes. But so this is just Cupric Canyon Capital. We formed in 2010, and as Cray said, Barclays from Barclays Bank had created a fund they called Barclays Natural Resource Investments. They later changed that to Global Natural Resource Investments, located in London, and they had approached us, the members that we later formed. We were a group of former Phelps Dodge employees and other companies that had were looking for something else to do, and maybe do things part-time and develop resources. And so it was kind of an interesting marriage. So Barclays at the time, or GNRI we call it, approached us, and what they wanted us to do was form a team of former executives and technical folks in our spheres, and then go find copper opportunities in the world, or other metals, but primarily copper, and so that they could make these investments. And so that we gathered together. This is a list of all the folks that were involved. Some full-time, some part-time. There were 5 of us to start with. A couple of them in the room today, but if you read through this, you'd see that there's some pretty high-level people that had been executives at a very high level in Phelps Dodge and Newmont and a couple of other companies, and with a lot of technical experience. Everybody had 30 or 40 years of experience. We also, I'd like to point out that I list on there an attorney, and I'll talk more about that in a minute, how important it is for when you start into an endeavor like this to make sure that you are getting good legal representation and all your documentation thoroughly vetted through a competent attorney, and we sure had one. His name is Aaron Kane. And so you might ask, well, why is it that they're so interested in copper? And well, it's pretty obvious to probably most people in this room, but we expect, or I expect, and I think that you would almost get consensus out of this in the industry, that we're going to have periods going forward in the next few decades of severe shortages of copper. And the reasons of that are the intensity of uses, we believe, is increasing or should increase, and we think that the rate of discovery and development of new copper production is going to fall short. And of course, some of the reasons for increase in use is population growth, probably going from 8 billion up to 10 billion. We expect and hope, and we have to drive for a higher standard of living for everybody, particularly those 2 billion additional people that are coming into the world, and I think the majority of them are going to be in Central Africa. And then, of course, obviously, we have this sustainable energy transformation in which we feel the need to move away from carbon-based energy sources and to more sustainable. And of course, when we do that, you're talking about electric cars, transmission lines, all sorts of infrastructure that goes along with it. It takes a lot of copper to make that conversion. And then there's a variety of ways in which new technologies are consuming more energy. So anytime the consumption of energy goes up, then that generally relates to an increased demand for copper, because copper is the way we transmit that energy. And of course, on the supply side, the new discoveries and new copper mines being brought into production is not keeping up, and aging mines is one thing that we've been talking about for a long time. And of course, permitting environments around the world seem to be changing, and they have been changing. It's been that way in the United States for a long time, but even in Chile and Peru, the permitting process has become a lot more onerous for a variety of reasons. And that, of course, restricts supply. So I didn't want to make you look at a bunch of charts on copper price, but that's what I do, so we're doing it. And so this is, looking back 60 years, more than 60 years, 65 years almost, of copper price. And you know, the one thing that you see about it is that it's very volatile over the long term. And you know, if you're an operator, you know, you think, man, that's a terrible thing. But from an investor standpoint, volatility is what they see as investment opportunities in volatility. And you know, I mean, buy low, sell high, or Warren Buffett likes to say, when others are greedy, you should be fearful. And when others are fearful, you should be greedy. And you know, so that's what kind of happens in the copper industry. And so I'm going to take you back to the early 1980s, and before most of you were born, by a long ways, I think. But many of us were in the copper industry at that time, and we went through this period of oversupply where there was just too much copper being produced and not enough consumed, and therefore the price that people are willing to pay for copper goes down. And that's terrible for operators, because you're trying to produce a product and sell it on the market, and if the price that you can get is low, that means that you have to produce for less than that. And so what happens when that occurs is the industry gets very innovative. And you know, so in the early 1980s, there were a bunch of innovations that came about because operators, the owners of mines, were just trying to stay in business. And you know, the whole idea is to stay in business until the price changes, you know, so you can make money at the high side. So, you know, what happens there is like modular mining, which had a lot of their founders from the U of A, created mine dispatch, in which you know, which is kind of a revolution in mining and really impacted costs. And there were a whole variety of other innovations that occurred during that time. And then, of course, what happens is that the investment into new copper mines, it goes to zero when the copper prices are low. And of course, what that does is creates the next part of the cycle, which is where it's undersupplied. So from the mid-1980s until in the mid-1990s, there was a period of time in which copper prices were relatively high. And so that what happens during that period of time is that people produce a lot, they make a lot of money, they get their balance sheets in good shape, and they make investments in new mines. But the other thing that happened during that period, which was kind of unusual, is that South American politics changed. So before this period of time, in Chile, the government had in the 70s had nationalized all the mines. Nobody was investing in Chile. It was too risky. So in the late 1980s, early 1990s, that changed. The politics changed. They started accepting investments, and there were a whole bunch of big ore bodies that had been sitting there for a long time. All of a sudden, people started investing in, and they came into production. And you know, they were Escondida, they were Collahuasi, there was Antamina in Peru, there was at Candelaria, a variety of them all came online. The other big fundamental change is that the advent of large-scale leaching and SXEW grew pretty dramatically at that time. And that's when the industry began leaching secondary sulfides in addition to oxides, and that brought a lot of additional low-cost production on during that time. And the result is that in fact we of course go into another downturn because we overshot and it was oversupplied, back to the misery for the operators. So during this downturn, there was also, we will go right back to innovation again, and there was a whole lot of work done with mine design, with work practices, all lowering cost and making all the various mines viable during this low copper price. But then something that happened that was really unusual, and that is starting in about 2004, China really started to grow dramatically. They're growing their economy and therefore their copper consumption. And it was such a big change that the industry couldn't keep up, and the prices went very high. And as you can see, they, with those of us that were operators at the time, when it got to $2 a pound, we thought, man, this is heaven. It can't get any better than this, and it can't last. But it did, and it, the copper price went all the way up to over $3, and compared to the 60 cents a pound that we were kind of used to working with. So really a big change, and it gave us an understanding, I think, of when the world starts consuming copper like we do here in the US or in Canada or in the developed world, or Europe, the developed world, when China and other countries start doing that, there's more demand than the industry can supply. And so that we believed then and we believe now that there's a really good opportunity for that. And I'm a firm believer that we're going to see periods of very high copper prices in years to come. And this will be a very profitable business and one that's very dynamic. But one more thing to talk about. We formed Cupric in 2010, right kind of at the high point. But one of the things that we didn't predict, but we kind of had in the back of our minds that could happen, is that this rise in copper to satisfy all this Chinese demand would overshoot. And that always happens. And there's a lot of sentiment in copper prices, in spot copper prices. There always is a lot of sentiment in it. And we felt like, well, that might come down. So we get, there's a lot of luck in this. I don't want to, if I leave you with the impression that we had a carefully planned program and executed on it perfectly, don't believe that, because it didn't. But we formed in 2010, and fortunately there was a relatively mild downturn over the next few years, and so the bloom came off the rose. So when we went out to try to find opportunities, we were doing that in a period of time in which investment was kind of drying up, and so junior mining companies that were trying to develop new resources, they were starting to get strapped for cash, and we had this good investment vehicle with GNRI, and it was kind of very fortuitous for us. And so from an investment standpoint, that was a great opportunity. So luck it favors the people that are prepared, and I think we prepared okay, and we took advantage of luck. So why do we think that there's the bullish factor? I've already talked about that, and I'm not going to go over that again, all the bullish factors that we see. But you need to keep in mind that the risk is always there. And from an investor standpoint, you're asking someone to give you money to go build a mine. They have all of these risks in mind all the time, and you should too. And so there's some moderating factors around what could happen to the copper price and to the market in general. And of course, you know, there's always a threat of economic downturn. We go into a secular recession that could last a long time, and that would obviously affect the price of copper dramatically. There's, you know, we had some technology changes in the past that affected the supply-demand balance, and so there's a sulfide leaching technology that probably everybody's heard of, in which we might be able to leach primary sulfides rather than just secondary sulfides, and do it in a heap leach fashion. And there's a lot of people working on that, and a lot of very good work being done. And in fact, Freeport is advancing the ball on that. And of course, you know what that could do. And for you, the mining engineers in the room, you would know that if you've designed a pit and on certain economic parameters, and if all of a sudden you're able to process primary sulfides a different way and at a lower cost, not only are you able to take advantage of waste material to produce copper, but you also change the economics so that the pit gets bigger. And you know, so that is something that I don't think very many people take into account when they think about their projections for copper prices going forward, is that from a supply-demand balance, there's a big factor here that if that were to come to pass in a big way, that could bring a lot more low-cost supply on, make the reserves of existing mines bigger, and be a moderating factor. You know, personally, I think that we need something like that if we're going to supply the world, and if the world is going to prosper and be able to build the infrastructure that it needs. In Africa, I'm going to talk about Africa quite a bit, but there's huge deposits in Central Africa and the Congo and around that region that, for political and social and safety reasons and so forth, hasn't been developed. And so if that part of the world ever really gets settled and the politics get right, and that's probably a couple of decades out, there could be a whole lot of new production from new mines in that region that people don't have on the radar now. And so these are the type of things that could add additional supply, put additional supply out there and moderate the price. And so those are the type of risks that you need to be aware of. You know, I've also listed artificial intelligence here, and you know, I know I have that on both sides of the equation. I have that as a bullish factor. I also want to talk about it being a bearish factor, and artificial intelligence is probably the wrong one. I just use that as an example of technologies that are advancing rapidly, and artificial intelligence could be something that teaches us how to use electricity and all energy way more efficiently. And you know, I think there's a real potential if you're able to reduce the consumption of electricity by just by efficiency means, if artificial intelligence gets us there, then that could reduce the amount of energy demand and therefore reduce the amount of copper that's needed to provide transmission for that energy. And so these are things that we need to keep in mind. Nothing is risk-free in this world, and so whenever somebody tells you that the price of copper is going high for a long time, for absolutely sure, they don't know. And you know, I'm one that will tell you that is very likely to happen, but I don't know either. And you need to keep that in mind. That's the risk that we live in, and there's no industry that doesn't have risk like that. So on our business plan, we I've already talked some about this. We formed in 2010, and you know, we wanted to look for new greenfield opportunities and maybe opportunities that had been overlooked because of one reason or another. And you know, we would consider acquisitions or minority investments, and you know, we had a partner in Global Natural Resources Incorporated, that they're private equity. And when you think about private equity, what you always think is that they want to make a quick investment and get out fast at a high return, and that's true, and you know, and so they justify that by you know, what they're doing is they're investing a lot of money and taking a big risk with it, and there's a reasonable chance they're going to lose it all, therefore they need a big return. It's all fair. We had a private equity partner in GNRI that was, I think, somewhat unique and surprisingly very good in this regard. And so I was surprised that when we got together and started analyzing opportunities, that how engaged they became. They would sit side by side with us analyzing opportunities and learning everything that they could about it and becoming expert. And you know, so the value of that is that they, you know, if you, normally you would have private equity investors that give you money and then come back later and check on you and give you trouble if you haven't made any progress. These guys were ones that number one, did a lot of study on understanding the copper market and the risks associated with it, but also understanding the mining business and opportunities and the risks associated with development, with reserves, with resources, and so forth. And so I think that they came into it, and after we spent a tremendous amount of time with them in dealing with all of this, and you know, I think they came away with a full understanding of the risks, and you know, so they, like every other private equity group, they would like to invest and get a quick return and leave, and that's, you know, that's fair enough. They were realistic about the timeline too, and so when we got into this and the copper price started to drift off, the investment climate went down, they didn't ever bat an eye. They just stayed with us through the whole thing. So I really give them a lot of credit for that. And we had some guiding principles that in Cupric is industry standards on safety and all ESG matters. If we're going to build something, we're going to do the same standard no matter where we are in the world, and it's going to be at industry standards. Anti-corruption, and anytime you're dealing in foreign countries, you have to pay a lot of attention to that. And then, you know, we pay a lot of attention to political stability and where we're investing. And so the type of investments that we were considering was a wide range. Greenfield projects, you know, that's these junior mining companies that are normally working on greenfield projects. And then we would also consider operating mines for sale and closed or orphan projects. And you know, we pretty quickly rejected the last two there, you know, because if we're buying an operating mine, the only way we can make money off of it is to buy that mine and improve it dramatically. And you know, if you're buying that from any operating company, they've already done that, and they would be operating pretty good. And so you're not going to do a lot of that. And then closed or orphan properties are usually closed or orphaned because of for a reason. And there's usually legal entanglements, environmental liabilities, all the complications, and we just decided quickly that's not where we're going. So I wanted to talk a little bit about, since we're we're now focusing only on greenfield opportunities this is kind of a progression line of how a greenfield project is developed. You start up with the discovery, and then you do a lot of exploration and resource definition and permitting and financing and construction and so forth. And finally you reach production over a long period of time. And so what's happening is that the risk of an investment is very high at the exploration end. And so an investor will look at an exploration opportunity or a new discovery, and they might want to invest early on, but they're not investing very much, but the risk is high. There's a good likelihood they're going to lose it. But as you go through this process, then you're decreasing risk, and by the time you reach production, you've eliminated most of the risk. But of course, the value, if you're an investor, your entry point, and where you're going to put your money and buy into this thing, gets higher and higher as the risk goes down. And so, this may be obvious to people. One thing that I want to point out to everybody, all students that are here when you enter the industry, you may not have money to put into a project like this, but you are investing your part of your career if you go into a greenfield project. And so the risk of you wasting a few years in working on something that doesn't pan out, risk is pretty high. But if you stay with it all along and you get to the end point, the reward should be high as well. So that's the way investors look at it. You are investing your career, your years in your career. Your investment is high as well. So just wanted to make that point. So we, through the 2010 and 2012 period, we evaluated over 200 opportunities. It was a really high rejection rate, just for all the reasons that I've already discussed. And we started focusing on Botswana and sub-Saharan Africa. Sorry if this is a fuzzy, I think it's probably all right. And so we came upon this opportunity in Botswana that we did like. And just to talk a little bit about Botswana as a country, it's in South Central Africa, Namibia on the west, and Zimbabwe on the right, and South Africa to the south. But it's a great country. Right up toward the top there, you see the Okavango Delta, where this opportunity was just south of that in what we call the Kalahari Copper Belt. And the Okavango Delta is a great location for animals all over the place. And you can see along the map as they have all these parks that are animal preserves. This country is one, they have a lot of diamond mining in the past and have gained a fair amount of wealth from diamond mining and wanted to diversify into copper. And so they were pretty welcoming, but they understand sustainability. And so they have the animal population that's just fantastic. And they know how to protect that asset. And so they're very sustainability focused, I think, relative to other countries in Africa. So it's a country with a very low population density, only about 4 people per square kilometer, and that's one of the least populated, the lowest population densities in the world. The sovereign risk rating for them is, by rating agencies, is always rated very high, 3rd or 4th in the world. And it's because of their business climate, their political stability is second to none in Africa. They had a president that was the president for like 20 years, and he recently retired, and he's replaced by somebody that's very similar to him. And they're very business focused. They're very very accessible. They take things very seriously, very seriously. And when I say they're business friendly, they get it. I mean, they understand that if somebody wants to come in and do business in a reputable manner with the good safeguards and doing things by industry standards, they're all for it. And you know, they're great people. Speak English, which is a big advantage to people like me. And you know that I've mentioned the sustainability culture. Their permitting laws are strict, just as strict as the U.S. or anywhere else, but they're predictable and they're very responsive regulators. And you know, we need a lot more of that in the Western world. You know, so there's no corner cutting, that's for sure. But you know what you want, and what we want is we can live it by almost any standard. It's just make it predictable, make it to where regulators are responsive and they have the bandwidth to actually make approvals. So anyway, that's why we thought Botswana was great. There was one of the things that as investors we look at and think about carefully is that if there's something that we might see that others don't, I mean, that would be something that we would be very interested in. So many of us on the list of technical people that were on our team had worked up into the north in the DRC developing Tinky Fungarumi, and so we got to know the African copper belt pretty well. And you know, there was always this understanding that the Kalahari copper belt, which runs to the south, and you can see it here running through Namibia and Botswana, you know, the industry perception was that it's relatively small. You're going to find small occurrences. They're never going to be able to put together any tonnage, and I'll show you why in a second. You know, just running through regional geology, and the real geologists in the room are probably going to roll their eyes at all this, but so this is Africa as it might have looked in you know, back 1 billion years ago. And it really wouldn't look like this. I mean, it was really part of Pangaea, where all the continents were together before it split up. And these sedimentary basins toward the south and west were, so they were filling up with sedimentary deposits that were stacking one on top of another. And there was an occurrence, and probably many of them, in which there might have been a shallow lake or shallow sea in which a lot of carbonaceous material and organic material gathered and formed a bog, if you can imagine that, and then that eventually, so it's filled with carbon, and so that eventually gets covered by other sediments, and so in the stratigraphic record, you can see there's this, the one I have circled is the copper silver. That's the strata that we are talking about here. It was a lot of carbonaceous material in it and so forth. And of course, carbon in an environment like that is a chemically reducing environment. And so over the years, there was a mineralizing event that occurred, you know, about 1 billion years ago, and according to the dating that was done. And when I say mineralizing event, you know, they were talking in millions of years here, so it's a little bit different than event. So the term event is a little, and then so we that strata was mineralized as hydrothermal solutions migrated through the strata, and what happens chemically is that the copper ions and iron and zinc and all the base metals and then any sulfur is in it. It replaces the carbon, and that's how you get copper in these deposits. And then about 550 million years ago, there was what they call a folding event. And again, event is millions of years. But so this was a period in which there was a lot of stresses and strains on the continents as they were moving around. And so there's these cratons that exist in the continent here. And what a craton is it's kind of a deeply bedded structure, rock structure, and it's kind of semi-immobile. And so all the stresses and strains that were occurring were affecting all these sedimentary deposits in between the cratons. And so you can see up in the African copper belt, toward the top of this map, that's where Zambia and the DRC exists. And the Kalahari copper belt comes through down a little bit lower. And so the same thing's happening. And so on the right, you can see that as these sedimentary layers get pushed together, it creates kind of a sine wave of anticlines and synclines, and that's what we started looking at. And so this is kind of a cartoon that just shows you that as these strata were folded and faulted and so forth. If you look on the right of this slide, that's where Zambia and the DRC, the African copper belt was, and then on the left is where the Kalahari copper belt is. And the big difference, there's a couple of big differences, but one of them is that, as you can see, the Kalahari side is covered in Kalahari sands, and on the African copper belt side on the right, all of these strata-bound deposits are exposed at the surface. So exploration's a lot easier up in the African copper belt and a lot harder in the Kalahari. And so a lot of the perception that the Kalahari would be small and you wouldn't find very much, you know, I think a lot of it is rooted in that and how difficult exploration is between the two. If you're always comparing to the African copper belt, then the Kalahari doesn't look good. But another reason that the African copper belt might be better is that it's higher grade, maybe as a result of a higher content of carbon in the stratigraphic layer when when the mineralization events occurred. So this is what the Kalahari Desert looks like with the Kalahari sands. Can't see any copper outcrops here because it's all covered. So, you know, what Hannah Mining Company, the company that before us had done was done a lot of geophysics, and this is the depiction of one of those techniques in which you can see through the sand and you can pick up where those strata are meeting the surface. And this is a cross-section of how that looks in the specific deposit that we're looking at. You know, so you can see the Kalahari sands on the front. This mineral occurrence that we were looking at occurs on the limb of an anticline, and it's dipping about 60 degrees. And so the red color is where that exists. And there's very competent rock that was deposited below this strata, and very competent rock above it. And that gave us the perfect opportunity to have a very stable mining operation where we could extract that mineral. And this is a kind of a cartoon that shows something similar, but Kalahari sands covering, and then where you get to the ancient surface before the Kalahari sands, the deposit is strata-bound deposit with very competent rocks on both sides of it, and it's about 10 meters wide and runs about 2% copper and 20% silver, or 20 grams per ton silver. And the primary copper minerals are bornite, chalcopyrite, and chalcocite. And it's an amazing deposit in that from one side of this to the other, the full 10 meters, the grade doesn't vary hardly any. It's very, very consistent from the top to the bottom. And we drilled it down to about 1,200 meters because it cost money to drill, and we didn't go much deeper than that. But we think that it's open at depth, and along strike, this is about 4.2 kilometers. So it's a significant ore body, and it's enough. There's enough ore in that geometry to give us about 20 years of production at 10,000 tons a day milling, and produce about 60,000 tons per year of copper. So a lot of this work had been done by Hannah Mining Company, they're a Vancouver-based, they were a Vancouver-based junior mining company, and they had a great vision and did a lot of really, really good work. But of course, when the copper price tailed off in about 2012 or so, they found it harder and harder to raise funds. They went IPO and did an IPO, and initial public offering, that is, and therefore they become a public company and gained a lot of money through people buying their stock. And because they were having trouble raising funds, they gave us the opportunity to come in and do an investment. We really bought into their vision, the work they'd done, what they saw, and then not too long after we bought, we found out that the company next door, who had built a 10,000 or 8,000 ton a day concentrator, was having financial trouble, and they went belly up because of some technical difficulties, and so we were able to pick up that too. So we ended up with this good exploration property. It was called Zone 5, and a mill, and so it was a perfect opportunity to take advantage of the market and those circumstances. And so the combination of those two companies that we bought gave us about 4,000 kilometers of land position with a lot of exploration potential, and we think that the exploration potential is high. And that's for the new owners, which is MMG. We ended up selling this to MMG in 2020, earlier this year. That's for them to worry about, not us, so I don't want to make a lot of comments about the future. About that time, we formed Khoemacau Copper Company as a local Botswana company that utilized talent from the whole Southern Africa mining industry. We didn't have those talents. And also, we didn't have the talents of doing this type of underground mining. Mining a strata-bound deposit like that is a specialized skill. So we got all those talents arranged and formed this company, and they were the ones that took it through the construction of the mine and operation, ramping it up in 2022. So this is a photograph of how do you access this ore through this layer of Kalahari sands, and it's called a box cut. And then this is a photograph of 3 box cuts that were installed in the initial, and I think this will expand out to 5 box cuts, but it's 3 different mines that are interconnected. And so that's what was completed and is operation now. The mill was an 8,000 ton a day mill that had been well designed and operated, but they couldn't feed it and so the company that owned it went belly up. We bought it and we modified it to 10,000 tons a day. And so, I know I'm just about out of time here. You know, keys to success, we had a very committed and engaged private equity partner. You know, we were willing to challenge industry paradigms in the Kalahari Copper Belt in particular. You know, we understood the market dynamics and the patience that is necessary to go along with that. We had a talented team of experts, and we weren't afraid to add talent when necessary. You know, you can't be Superman and don't think you can do everything yourself. Make sure you gather resources elsewhere when you can. And you know, so in summary, it's a good operating mine now, and MMG is the owner of it and operator. They're a Chinese-owned company that operates out of Australia, and so they have a 60,000 ton per year copper producer here, and for 20 years, and we think they have a lot of upside, but that's for them to determine, not us. We created 1,600 jobs in Botswana, in a place that is in need of jobs, obviously, but it's a big impact on the area and the community, and a lot of wealth is created around that. And so when you have the multiplier effect, it's probably multiples of that 1,600. And of course, breaking the paradigm on the Kalahari Copper Belt is very important. So I think that was the last of my slides. So I can't see anybody, but if there's any questions, I'll be happy to take them. Great. I know it's about 5 o'clock. Do you want me to take questions or not? Okay. If you can see if somebody's raising their hand. Well, apparently not.
You mentioned that the majority of projects are investments in potential mines. In this case, Hana was an existing project, and they did have already deposit and a concentrator, and so the process here is not, is improving it or expanding it before it was sold to MMG. Is that right? I mean, is that like a sort of a refurbishing, but making it much better, more attractive for production?
I'm not sure I caught all of that, but so we were very fortunate in that. Number one, we caught the copper cycle right, and were able to get Hana and all the good work that they've done and progress it. And we were very fortunate to have this concentrator right next door, and those were the two big factors. And that obviously, the fact that we were able to execute this at very, very low capital cost. And of course, if you're going to make investments in copper or anything else, what you try to do is make the investments, keep the investments low early on, and backload all your costs. And we were able to do that. And the fact that we got this concentrator very inexpensively made it to where this was a very efficient capital program, and therefore that did make it very attractive to a lot of investors. When we told the industry that we were considering selling this, we had over 30 companies that expressed interest, and more than a dozen of them made actual bids. It was a good auction process. I don't know. Did I address your question? I'm not quite.
I know I saw
You know, that's such a great question. You know, that, and the question is big copper companies, big companies in general, they don't invest in exploration. They don't invest in as much as they should. I would tell you that all the big companies do have exploration going on, but there could be more, and some don't. But junior mining companies have been filling that role, or have in the past. You know, it's an age-old question. Oh, that's great. Yeah, thank you. It's an age-old question. Do you invest in that? Because you got to know that exploration, raw exploration, is a very low probability thing, but high impact when you find something. And
because in the last 20 years, we don't have any Snider or Morenci in the news. It's just all the time the news is that Morenci is increasing, or Snider is increasing, Chile is increasing. Just in mines and production. And this is a question.
yeah, I mean, it's a great question, but fundamentally, you know, all the big companies are publicly owned. You know, so they sell their stock, and that's how they get their value. But you're measured on quarter-to-quarter performance. And so if I'm going to spend a whole lot of money on something that's not going to produce for 10 years, my investors, all my shareholders, are going to go buy somebody else's stock and sell mine. And that's the nature of what we're dealing with. But I agree with you, yeah, that exploration discovery has been low for a long time, and we're starting to see the effect of it. But you know, it's unlikely that that's going to change. The other problem is the number of investable countries, like Chile and Peru and a lot of places in South America and elsewhere. The investment thesis around those countries has diminished somewhat because of social unrest and changes in permitting structure, and all of that type of stuff has made it a lot less attractive to do exploration in some places. But I mean, it's a great question, one that you'll never get a good answer for, but you might get a better one than mine. But okay, you know that. Can I just tell one quick story? I wanted to talk about an employee, and there's still some students here, and I appreciate you staying. But one employee that we picked up with Hannah was a geologist, had graduated from the University of British Columbia, working there in Vancouver, and not too far after she graduated from college, she joined Hannah Mining Company, and you know, kind of liked the idea of this, and she was instrumental in learning and becoming a good geologist and going through all of this process from discovery to drilling the deposit out to assessing all the metallurgical and mineralogical work, to you know, the resource definition, to drilling it out and doing a wonderful job of managing all of that, and all the way through construction and all the way to production. That's rare that someone can start at one end and finish in the other. And just think of all the experience as a geologist. And she got to work with great geophysicists and geochemists and all sorts of geoscientists and engineers and so forth all along the way. And she was really the glue that kind of held all of this together. And it's a great example. That can happen. And I think it's going to happen. And you know, I only wish that I was just graduated from college in mining, because I think the probability of that type of thing happening is higher today than it ever has been. But just one other thing about that. What she did is she was actually raising a family, had kids in Vancouver, and commuted back and forth, and did a lot of work online, which is possible today and never was in the past, where you can do all of this work remotely. but she worked for good bosses, crummy bosses, irritating people, good people. She worked with engineers, with environmental engineers, with everybody, and a wide collaboration. She and never worried about who got credit, never worried about political type things within an organization, but just kept her eye on the ball on this ultimate end, which we got to. And there's a great lesson there. And you know, so when you go into industry and you get a job and you're an engineer or a geoscientist, and there's a lot of distractions, a lot of politics in the organization you're in, and competition and all of that type of stuff. The way to get ahead is to keep focus on what you're there for and ignore everything else and collaborate widely with people is the way that happens. And she's a great example of that. And she did pretty well. So, all right.
Tim, thank you for a really outstanding lecture. I'd like to invite David Hahn, our Craig M. Burge Dean of Engineering, up to present you with a small token of our appreciation.
Thank you.
It's not so small.
Not so small. Step over here.
Yes.
Okay.
See that?
Thanks. Thank you. Okay.
Well, again, I just want to say, Tim, that was a fantastic lecture. The spirit of the Lacy lecture was fulfilled with our founders sitting right here, Tom and Peggy. And I think we had pretty much a standing room only crowd, so it was great. But also, in addition to a wonderful lecture, thanks for spending time with our students. I had a fascinating conversation with you yesterday. You hit the engineer's breakfast. You put a lot in, and thank you so much for that. Let's thank Tim one more time. We are going to keep you here just a few more minutes because we have a special bonus to add. The College of Engineering in 2017 established our greatest honor to recognize our alumni, the College of Engineering Hall of Fame. It recognizes people that have had stellar careers professionally, exemplary service to the community, philanthropy, people who have been out of the college for 50 or more years. We have a celebration in the spring, and we honor our class, typically 4 to 5 to 6 people. We had one special honoree this year, Tom O'Neill, who could not make our spring celebration, so Tom is with us today. And Tom, I ask you to come up because we are going to recognize you today. Tom. Tom earned his PhD in 1972 in Mining and Geological Engineering and basically had 2 stellar careers, one in industry and one in academia. In industry, he served on numerous mining companies and boards of directors, was president and COO of Clifton Cliffs, one of the largest producer of rolled steel in America. On the academic side, he spent basically 20 years here at the University of Arizona in Mining and Geological Engineering department, including 6 years as department head. Not only does he have a PhD in Mining and Geological Engineering, he also has a minor in finance, which is very relevant in his roles as COO, but also in the spirit of outreach and the land-grant mission of this university, he consulted with many indigenous tribes on royalties, mine evaluation, really gave back to the community in so many ways. He was president of SME, and the greatest honor, of course, in the engineering profession is being nominated and inducted into the Engineering National Academy, and he is also that in 1999. So he's an exemplary member of this profession, and we're such proud to have him as part of this college. And I couldn't think of a more fitting time to recognize you in front of your own friends and community in the very Lacy lecture that you and your wife established. Tom, congratulations. It's substantial, and it's our pleasure. pleasure to recognize you in the 2024 College of Engineering Hall of Fame.
Thank you.
It's a well-deserved.
Thank you, Dave.
Thank you so much. Thank you. I think we could get a quick photograph as well. Why don't you come over? Craig, come with us. And Margie's going to take that.
I'm the shortest one up. Okay, thank you very much.
All right. Craig, you can take it away.
That concludes our festivities, but please join us for a reception outside afterwards. Thank you for coming.